everyone, this is Dr. Barry Burns with TopDogTrading.com, and this is the first video on our market cycle series. And so in this video we're going to talk about simple up-down cycles. So let's jump right into it. We're going to move along pretty quickly. So we all know that the market does not move in a straight line. It doesn't just go straight up. Most of the time it actually goes up and down, up and down, up and down as it's meandering, whether it's going up, whether it's going down, or even if it's going sideways. And this is what I refer to as up-down cycles. From bottom to bottom, that is a full cycle. From bottom to top, and from top to bottom, each one of those is a half cycle. Now generally in uptrends, according to the textbook pattern, we are looking for two things, and that is for the half cycle going up to be longer, the range to be longer. So there's your range, than the half cycle that comes down, and that's your range on the down cycle. The other thing that we're looking for is for it to spend more time going up. So that is your time going up, and that is your time coming down. And if you're looking at this as a bar chart, you would see that it has more bars going up and fewer bars on the retraces. Now again, those are textbook examples, but in real life the market isn't quite that neat. In fact, it's rarely that neat. What happens in real life is cycles expand and they contract, and they don't all make higher highs and higher lows in an uptrend. So for example, we might get a market that goes up, down, whoops, comes back down again, and then goes up. Well, each one of these are cycle highs and lows. And it's still an uptrend, but not every cycle made a higher high and a higher low. But that's all right. That's still a cycle high, that's still a cycle low, that's still a cycle high, and that's still a cycle low. Because cycle highs and lows do not define trends. They really just mark time. They're marking time. You have two axes on your chart. Over here is price, and down here is time. And cycles are about this axis down here, really. They're about time. Now the reason that understanding cycles are so important, or is so important, is that when you get into a trade is critical. And this is something that a lot of people are very, very weak on. So in an uptrend, we like to buy low, sell high. Buy low, sell high. Everybody knows that, basic principle of investing and trading. But the question is, well, when is the low going to be put in? And that question is answered by cycles. Knowing when this down cycle is over, when, meaning time, when, meaning time, that is the time to get into the market back on the long side in the direction of the trend. And that's why cycles are so critical to effective and profitable trading. Alright, so let's pull up a chart, and so we've got our Euro US dollar 5-minute chart here. And now, where are the cycle highs and lows? Well, of course, it's great in hindsight to mark this, but just eyeballing it, you could say, well, maybe that's a cycle low, that's a cycle high, cycle low, cycle high. Kind of makes sense. But how do you know? Or maybe actually that's a cycle high and that's a cycle low, that's a high, that's a low, that's a high, that's a low. And maybe these little mini cycles in here and even here. Which one's right? They're both right. And that's another aspect of cycles. is that, first of all, they can expand, so they can be big, and then they can get smaller. They can contract. Another thing is there's different size of cycles. So you could be measuring a large cycle like this one, or you can measure small cycles. They're both cycles, they're just in different scales. Both are right. And a lot of people like to measure more than one scale of cycle on their chart. Now, how do you do that? There are many different ways of measuring cycles, and obviously we don't have time to go into all of them in a brief video like this, but there's been a lot of time and effort and mathematical expertise put into this topic. There are a lot of proprietary cycle indicators that have been created over the years, and some very ingenious approaches. But for our sake, we're going to just try to keep things simple. And one of the most common approaches to measuring cycles is to use some sort of oscillator. Well, people have used the RSI, stochastic RSI, all different things, MACD even, and like I say, created many proprietary indicators for cycles also. So we're just going to look at stochastics here today, and this is a 3-period stochastic on the top, and I think this is a 14-period stochastic on the bottom, just to demonstrate. Now, there's different ways we could define this, but again, just for the sake of analysis, one way of measuring a cycle would be to say, well, every time that the stochastic comes back down below 30, we would consider that a cycle low, and above 70 a cycle high. And what you'd be doing is looking for the highest high in price when stochastic gets above 70, or the lowest low in price when it gets below 20, or in this case 30 actually. And you could put different numbers here. Some people use 20 and 80, some use 25 and 75. Right now I've got 30 and 70 here. So again, is there any right or wrong? No, the truth is nobody's mastered cycles because they're changing all the time. And I've gotten away from using proprietary indicators for it because cycles are very, very tricky, and they're kind of slippery and fluid. So it's one of the 5 energies we measure, but by itself, very, very unpredictable. But when you combine it with the 4 other energies, and all 5 energies align at the same time, then you got something special going on. But for the sake of illustration, so we would mark this as cycle high. There's your cycle low. Now we're looking for the highest high when the stochastic gets back above 70 before it gets back down below 20. That'd be about there. Gets back down below 20 there. And there's the highest high there. There's the lowest below there. So here our cycles are boom, 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 boom. And as you see, this coincides very much with an uptrend. We spend more time going up, less time going down. Our amplitude is more to the upside and less to the downside. And so that works pretty good. Now we could use this other stochastic indicator, which is the same indicator, it's just a different setting. It's at 3 instead of 14, and it's going to measure faster cycles. So there's a high, there's a low, there's a high, a low, a high, a low, high, a low, high, low, high, low. Now it goes for quite a ways, high, low, high, low, high, low. And again, it just measures a different scale. But these would be potentially bipoints in here. And you notice here is a good example of how we get a little ABC pattern coming down on the smaller cycle. But they're still cycles. It's just measuring time. It's an uptrend with a little ABC pattern coming down right in here. And these ABC patterns are great. I love them. So that's a little introduction to cycles. The way that I personally measure cycles is provided in my first foundations course. I've come up with a way that I really like to do it, but there's many, many different ways of doing it, and this is just your basic up-down cycle to help you time when to get into the market, especially during trends, but it also works great in sideways channeling markets as well.